All right, so what was the big news for the day today? That the president's councils are disintegrating. But you know what? It didn't really affect the market to the downside. However, the market could not sustain the rally. So I think we've got some waiting to do here to make sure that the market is ready for the next leg up. As I've said, I do have some concerns here that we're not getting this follow through. I did say in Sunday's newsletter that the North Korea thing would blow over, but then we'd have to see how strong that recovery is. And we did have a good start to the day on Monday, but the market did kind of fall flat after that. In fact, those of you who attended yesterday's webinar know that I was looking to do the Amazon call credit spread out of the money at 50 cents. The trade did not get executed, and today the stock fell back another $4.56 with a low of 973. So I think we're going to have to wait for another opportunity there. Another one that I'm looking at is Priceline. Priceline has an absolutely horrendous chart. I think it might have been too loud before. So what did I do here? I talked about this yesterday, and I talk about it on almost every webinar we do. Part of the game, part of the option trading game is like chess. You want to be able to think a move ahead. So here's a move ahead. If tomorrow, for some reason, I decide to do the roll and I get the cost down to $1.80, this is what the spread is going to look like next Friday. We'll have break evens down to almost 50 and 55.25. Now, obviously, if the stock starts moving up, we're going to roll again. We're never going to let it get up there. Okay? If we decide not to roll, then this is what we're going to have this Friday. Right there. This says 260. So we have to look at this and say, okay, it's $44 against a 260 cost, but we're at a 215 cost, so we got to add another $45. So we can get the stock back up to 52 by the end of the week. And we only have a couple of days, so I'm not going to hold out for that. We should be able to make $44 on that. Based on this model, the 260 cost right here is 45 cents more than the cost that we actually have. So we got to add that 45 cents back. So 45 and 44, 45 and 40, 80, let's call it $85. That would be a nice trade because we started that on August 7th. So if we decide to unwind this in the span of 10 days, that would actually be a very, very attractive profit. Okay, so we're a little disappointed that the stock's backed off over here. We're at 50.87, but we are still at a slight profit in that trade on that Amberella because our net cost is only 215 and this trade is at about 230 right now. Same thing is happening with the JP Morgan. In the JP Morgan, our net cost is $2.91 because on Monday We sold this Friday's 93 call for 40 cents. So now we're down to 291. Well, where's the stop? Where's the trade right now? Right now the trade is at 290. So even though the stock again backed off right there to 92.09, it was as low as 91.88 after being as high as 93.23, which would have been awesome for us. We're still holding at a break-even price of 290. If we go over here and we analyze that one, we throw the JP Morgan in there. Okay, we do the risk profile on that puppy. Okay, remember we're 291 and this is showing 375. So 375 from 291, let's call it 290. So that's 85 cents. So this is actually not on Friday. If the stock got back to 93, we would not have a $92 loss on this. We'd actually have a little over a $300 profit because it's a 5 lot. But this is the kind of shape that we're in right now. We have the stock at 92.09, which is right there. So you can see we're down about $400. The difference between the price as shown that it's marked against, which is 375, and our 290, which is 85 cents, is the $400 difference. That's why we're at a break even. Okay. Now, if we wanted to think about a roll, let's do the trade. And let's get rid of this. Let's get rid of this. Let's go here and let's go here. Whoops, that's Alexion, not JP Morgan. Hang on, let's go back here. Let's add a simulated trade. There we are. And we're going to buy this guy back. And let's see. Let's just stick with our 93 call. Okay, so that's another 30 cents. Okay, that's another 33 cents. So if we're at 290 and we subtract 30 cents from that, we're at 260. So what are we at? 375 over here. And we want to get this down to 260. We need to make this a $1.15 credit right here. So we could adjust this. You see what I'm doing? I'm adjusting the credit upwards so that it compensates for the fact that we're being marked at this higher price. So now let's see what the story is. And of course, we have to go to the second expiration. And there we are. So the stock right now is at 92.09. Where are we? 92.09. And there's a very, very slight profit there. But clearly, if we get the stock back to 93, we're back up to our $400 profit. Okay? So we're still in good shape here. I would hope that the banks would continue. Now, if we didn't want to do that trade, okay, watch this. What if instead we wanted to, whoops, let's get rid of that. Sorry about that. Let's, okay, now we'll do a new one. Right there. We buy that one back. And we'll sell the 92.5. Okay, now that 92.5, that's a 54-cent credit. So off of our 290 current cost, that gets us down to 236. That's pretty awesome. In 236, let's call it 235 off of 375. is actually $1.40. So we got to make this $1.40 credit, and now you're going to see something really fascinating. Now when we do the risk profile, okay, right, you could see it. We've got this guy right there, which now lines up at 92.5. We make a little less money, 338, but we make it a half a dollar less. Okay, so if the stock is languishing here at 92 in the next couple of days, that is actually a viable roll. We could actually do that, and we can get our cost down even lower to $2.35, $2.36, which would put us in really great shape because we're going to have a whole month left to collect additional premium. Okay, so that's how you plan out these trades in advance. Okay, you make the adjustments. You make the adjustments. Okay, let's take a look at Pepsi. Pepsi is still in gear, and I was inclined in my real trading account to actually get rid of this at 320. We're long this at $2.34, but if we go over here and we add our simulated trade on Pepsi, you'll see something again very, very fascinating, because options are fascinating. One expiration. There you go. Pepsi, Pepsi, Pepsi. Let's get rid of this. Get rid of this. Okay, so here we are with the stock at 119.10. So let's line this up at 119.10. And this is a 2 lot. I went back to 1 lots, so that'll be easier for us to learn instead of doing the default, which was the 5 lot. So we're really focusing on the per spread profit and loss here. So we've got a 2 lot here, which actually has right now about a profit of $90. That's where that 320 came from. But if you recall, one of the things that I showed you yesterday was that if we go and we look, if the stock actually backs off a little bit, because we have the last 2 days. Hold on, let's day step through this. Let's do a 1 day step. Whoops. We'll take let's do 2 day step. There you go. It's really hard to see here, but you get the idea. As the stock backs off a little bit because of the positive theta we have in the trade, actually backing off a little bit is a little bit better for us. Let me just go to the expiration since there's only 2 days left. It'd be kind of silly. So see, it's actually better for us now if the stock backs off a little bit, because right now we have an unrealized profit of about 90 some odd dollars per spread. But by Friday, if the stock actually backs off back to that strike price of 118, we're actually up over $100. So while I was contemplating selling the spread today, I realized, hey, if the stock opens up a little higher tomorrow, we could still have a nice profit. If the stock backs off a little bit tomorrow, because the market has just been kind of sitting here. So although the consumer staple stocks, which is what you're seeing, in this group here, this Pepsi trade and the MasterCard, not the tech, not the Fangies. By the way, Netflix doesn't look that great either at this point. If the stock backs off a little bit, we can definitely look to take this off. Of course, if we wanted to, right? The option police will not arrest us if we decide we want to roll. So let's take a look at a roll. Now you can see rolling to the 119 is not going to help us. So with the stock at 119, we'd actually have to roll to the 118 call. And while that gives us a $38 credit, if you notice, I don't think. Gotta get this to 2. Sorry. I'm so old. Go to the second expiration. Yeah. We are making some extra money here if we do that roll. And here's our $200 profit or so. So I guess it does have some possibilities, but given the way the market is behaving, I think we're going to lean towards taking that profit if the stock backs off right there. Okay, so that's again what you do. Okay, that's what you do on the Pepsi. Okay, so where are we worried? We're worried for eBay. The stock did start coming back today. Okay, this thing is just going to make us wait. I've got a strange feeling. But the problem is that we're starting to get into some negative theta. Even though we do have nice delta, we made very little money today on this move. And we are back to 46 cents, having started with 84 cents. So, losing 38 cents would not be the end of the world here. So again, we're starting to, I know I've been talking about this day after day after day, but we are starting to run out of time on that. So, of course, Schlumberger is the one that we're kind of sucking on here. Stock is very, very oversold. Definitely want to convert it into a bear call diagonal when we get a chance, but I don't want to sell into this weakness because if we do get an oversold bounce, I'm going to be chasing my tail over here. So we're down about $1.70 on that. So we have till November on that. Okay, new trades. AbbVie. We put on a new trade today. We bought the November 70 put for $2.63. We sold the September 67.5 put for 37 cents. Let me show you the chart. Let's go to AbbVie. There's your sell signal. There's the confirmation of the sell signal. And here's the stock did give it up a little bit towards the end of the day with the rest of the market. So we are not positively predisposed to this. So what we're looking for is the stock to break below these lows, 69, possibly carry down to 67. So what does this trade look like? We're going to go to Analyze, Add Simulated Trade. We'll go to our friend AbbVie right here. And we'll do our risk profile. And there you go. See, we could obviously hold on to September expiration. So we're giving the stock about a month to get down there. If it does get down there sooner rather than later, we're still looking at a $70 plus profit on a dollar, on a $2.20, whatever, 6-cent net debit. So that would be nice, making 30% in the span of a couple of weeks, a week or two would be great. I'm not going to send the money back. But if the stock does take a little bit longer to get down there, that's fine. Obviously, if the stock moves up, we can buy back the September and play for more premium collection. In the Verizon, we actually doing the opposite. Perhaps this is consistent with what we're seeing with the MasterCard, Pepsi, Procter & Gamble's of the world. More safety. We've got a lot of support here in the 47 area. Potential move back up towards 50. So what do we do here? We did where is it? Right there. Let's get rid of that. And there's our Verizon. We bought these December. It's a very low volatility stock, so we went all the way to December to buy the 232 call. We sold the September 49 call. The stock's 48.41, and we paid $1.84 for that spread. So where's our high 49, $50 price target right there? That's a quick $30 to $45 hit on that. And again, it's a low volatile stock. We're not expecting a ton, but the stock is at a very strong support area, and it looks like a low risk trade. And with low risk should come lower returns. So those are our new trades right there. AbbVie on the put side, Verizon on the long side. Now I want to go back to the Alexion. Hold on, I want to go back to the Alexion. Okay. And what I want to show you is, first I want to show you the Alexion chart. Okay. It is a biotech. Okay. Here it is again. It's been on a buy signal since June, holding support, 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 support. Let's say we are looking for the stock to get up into this 140 area in here. Okay, here's the 2-hour chart. Here's the daily chart. So we're looking in this 140 area. And what do? What we could do for September for $3.38, we could buy the 130, 140, 150 butterfly spread. Okay, with the stock, where's the stock? What did we say the stock was? Did I put it up here? There we go. The stock closed today at 137-ish. So here, we'll go right here. That's a little bit easier to see because it's 2 hours. Yeah, 136 and change. So right now, if the stock were to stay right where it is, we'd actually make some money on the trade on September expiration. If that would be about a $300 profit or so, right? Because if the stock's 136, the 130 call's worth 6 and change, right? If 136.55, right? That the 130 call's worth 655, we only pay 340 for it, so there's your $300 profit. If the stock can land exactly at 140, we make our maximum profit because it's a $10 spread. And if it moves above, you can see we start giving back some profits with a final break even of 146.62, and then we actually start losing money, right? Because we're long a $10 spread, we're short a $10 spread, and that's how that works. Okay, now here's what I want to show you. Okay. As stocks go up, right? As stocks go up, we expect the level of implied volatility to go down. And we also know that because of the way the butterfly is, the middle strike, if the stock reaches the middle strike, that strike will be the at the money strike, and it will have the highest vega, right? So this is going to be a negative vega trade when the stock gets to 140. Okay, so how do we model that? Well, what we can do is we can step through these different volatilities of 2% change each, meaning we're going to stay right here. See, here's a 30 volatility, then there's a 32, a 34, and a 36 volatility. So what we can see is that today, if the stock just stayed right where it was and the volatility actually went down, you'd actually have a profit, right? So if we move this date ahead, okay, let's move it ahead. I don't know. It's a September. Let's move it ahead 2 weeks. Okay. Now you can see how this thing is starting to really benefit us, the decline in the volatility. So the butterfly spread gives us that ability to look at what happens to us if our expectation is correct that the stock moves and the volatility goes down. Okay, because at 140 here, right, we're up $100, and if we change, let's do this volatility again. Okay. In fact, I made a mistake here. See, that should be a -2. Okay, now we're gonna. There we go. Much better. Okay, so now we got our $100 at our regular volatility. We've got a little bit more profit at 2% less volatility, all the way down to 24. So you see the difference here just in one on August 30th. Okay, there's a big difference. Here the profit is about $100, and here the profit is almost $200. So and over here, if the stock just stays the same, the difference in the profit is $76 to $138. So remember what we talk about in the course is the butterfly spread is better for bullish. The put calendar is a little bit better for bearish because the put calendar spread is a positive vega trade. And since when stocks go down, we expect the volatility to go up. We want the calendar spread because the option we own, which has the longer expiration, is going to have a higher vega, right? If they both have the same strike price, the longer expiration has the higher vega. In this case, because it's a negative vega trade as the stock approaches the strike price, the put calendar being a positive vega trade as the stock approaches the strike price, we would prefer to do the butterfly for the upside and the put calendar for the downside. And here's exactly the reason why, right? You actually do better at the same stock price. See? Because once you're in here, you're into it's a negative vega trade. As opposed to here, you see how they flip, right? As you get too far away, it then becomes a positive vega trade, and that's not good if the volatility goes down, right? Obviously, if the stock goes down, the volatility could actually go up. So if we took this away, right, and I hit enter, see, it actually flips. See, it flips. It gets a little less worse. It's still pretty bad, but less worse. It's still pretty bad, but you can see if once you're down here in the positive Vega area, the increasing volatility actually helps you. So theoretically speaking, if the volatility really, really went up, you would lose a lot less at the same price. See right there? You'd lose less at the same price. Okay, so that's today's lesson on the Greeks. All right, folks, that's what we're looking at today. We'll be traveling tomorrow afternoon. I will be making any adjustments. I will have a chance to make a couple of trades in the morning if something shows up for us that we can talk about. Thanks for joining us again. It's always a pleasure to have you here. And good luck, good trading. See you Monday. And pick up the newsletter on Sunday. Thanks. Take care.